Welcome to Morning Trade with Moneycontrol in association with M-Stock by Mirae Asset. I'm Karunya Rao and I'm here to help you navigate the trading day with actionable trading strategies, sectoral trends and most importantly, your queries during the course of the show. So keep commenting on our live feed on YouTube and we'll have it addressed by our guests on the show. But before introducing our guests, let's see what the global handover looks like. Markets across the board are back deeply into the red. European stocks fell sharply on Thursday as hawkish policy actions from central banks fueled worries of a possible recession. Stock 600 fell 2.5% with tech shares tanking 4.7% to lead the losses. Other key indices skid more than 3% each. Dow fell below 30,000 for the first time since Jan 2021. The 30 stock average is down 4.7% for the week, on track for its 11th negative week in 12. The tech-heavy Nasdaq was hit even harder and is down 6.1% for the week. S&P 500 is down 6% for the week, which would be its worst weekly performance since March 2020. All 11 of its sectors are at least 15% below their recent highs. In Asia Pacific, stocks are also trading lower today following the decline on Wall Street. Nikkei is down over 2%. Hong Kong and China are down nearly 0.5%. Investors eye the Japanese central bank's decision, which comes on the back of monetary policy tightening by global peers earlier this week. And the SGX Nifty trades flat, indicating a muted start for the Lal Street. All right, let's bring on board Rahul Roy Chaudhary of Equirus Wealth to talk about markets and more importantly, if it's the right time to take a close look once again at your portfolio. Rahul, thank you for joining in. I'm sure you've been bombarded by a lot of questions of late about what to do with your portfolio holdings across the asset classes. We're looking at a sell-off across not only markets, but most asset classes have also weakened quite sharply. So tell us, in a market like this, what should one do?
Thanks. Good morning.
I think we've lost Rahul's feed. We'll have to get back to him. Meanwhile, let's touch base with Gautam Shah of Goldilocks. He's here to talk technicals with us. Good morning, Gautam. What is the trade setup looking like? Are we staring at a move up back to perhaps 16,000 levels, or could we retreat further from sub 15,400 actually?
Good morning. Well, I just feel that the market was living in hope in the last 1 week because I think the nation was really watching this level of 15,700 because in the last 4 months, every time the Nifty came close to that number, there was a rebound. But this time, I think there were just too many factors that triggered a breakdown, and the breakdown did not look good because nothing was spared. So given the kind of fall that we saw yesterday, it does seem as if the market has some more near-term downside. I think our working numbers now on the downside are about 15,000 to 15,150. So there could be a drop into that zone. But from an investor's perspective, I think the stand that we've been maintaining for the last few weeks is that you cannot go wrong, investing at these levels. I think the risk reward is extremely, extremely lucrative. I know the scenario currently is very pessimistic and, there might not just be any positive aspects to look at. But I think if you really go by the breadth data and you study it over the last 20 years, the kind of damage that broader markets have seen, mid caps and small caps, I just feel it's a little overdone. And right now, I think the damage is really restricted mainly to the large caps and the indices, which actually in some sense haven't fallen so much. So I still believe that the market is retracing the bull market that we saw in 2020-21. The time correction is more or less done. Maybe another 4-5% price correction maximum before things get back on track.
So are you telling people that this could be a good time to buy into the stocks that they have missed out on when the markets were running up 6-7 months ago?
Well, when such scenarios play out and given the kind of sentiment that we have right now, telling people to go ahead and buy is generally not looked at in the right sense. I think that's what always happens at the bottoms, whether you look at 2008, which I happened to live through, and also what happened in March 2020. But I said, if you go by the longer term statistics, on the charts, on the valuations, looking at psychology, looking at sentiment, and the kind of price damage, I mean, the average decline across NSE stocks is a little over 40%. So that's the average drawdown which stocks have seen, and fundamentals just don't matter. So as I said, from a trading perspective, there is no clarity because there could be another 2-3-4% downside. But from an investment perspective, around current levels, plus minus a few percentage points is a good time to go ahead and make that investment.
Okay, all right. So what are the kind of indices that you are looking at closely right now? Of course, Bank Nifty must be top of the list, but any other packs that that retail investors can also keep on their radar?
See, this is a good time to go basket buying. I would not recommend stock picking because you don't know whether that very stock is going to recover with the market when the rebound happens or not. So the best way to really play the current market is buy a nice, good, well-diversified basket of, say, 25 to 50 stocks. It could be through various mediums, So I think small caps and large caps is where I am personally recommending for basket buying. And in terms of the, large caps and the indices, I think I'm still convinced that IT is a story for the next 6 to 12 months. I think the drawdown has been a little overdone. And after yesterday's move, many stocks are extremely oversold. So I would look at that. I would also look at telecom. So we are talking about Reliance and Bharti, which has been steady all along. So that's a pack that we like. Autos we like. So M&M, Tata Motors, Maruti, all setting up very, very well. They have shown a lot of relative strength in the recent past. I think that's a theme to look at. And real estate, something which has been my favorite since almost a year now. Yes, it's seen a large correction, but many of these top stocks, DLF, Oberoi Realty, Prestige, Brigade, they don't have much downside from here. So again, investment positions in some of them can be considered as well. And not to forget FMCG and ITC, which has been, one of our recommendations for many months now. I think it's a steady name and will gradually give you much better than Nifty returns over the next 3 to 6 months.
Okay, all right. We're getting a lot of questions on IT companies. But before that, I would like to also flag off a Wipro. Some corporate development has transpired there. They've signed an alliance agreement with Equirus Investments. This is primarily to evolve and scale AI and ML-based content localization solution. And these solutions will be available to media and entertainment companies per se. Let's talk about Wipro, and if you could also share your view on the broader IT space. It's been a rough year for IT stocks after witnessing a phenomenal run-up last year and even the year before that. So what is the trend that you foresee for Wipro and for its peers?
Well, first things first, you need to see the kind of rise before we understand the fall. Because I think a lot of people are saying that, okay, so-and-so stock was at certain level at October 21 and it's currently this much. So it would have fallen about 40-50%. Let's not forget in 2020 and 21, there were many stocks and many indices that moved up 5-7 times in value. So when you run up to that extent, there is always a retracement of 38 to 50% that can happen. Wipro has been one of the stocks that we've been liking. We've not been on the right side of things for the last 1 week because we've been banking on this particular name, and it's broken most support levels just like all other IT names. But again, let's not forget Wipro was at 750 rupees, just a few months back. I think fundamentals haven't really changed. The tailwinds haven't really changed. And despite that, the stock has fallen 40-45%. So I just feel that it's a little overdone. Don't look at it day to day. But if you have a medium-term view, buying into stocks like Wipro, TCS, HCL Tech, Infosys at these prices, again, I just feel that the risk reward is lucrative for longs.
Okay. I want to talk about some bulk deal action as well that has transpired on certain counters, and Dr. Reddy's is the first one on the list. LIC has acquired an additional 2% stake in the company via open market transaction. So now their shareholding in the company stands at 5.6% versus 3.6% that they were holding before. DRL has seen a good up move, Gautam, in the last 1 month from 3,800 levels. It has climbed slowly and steadily. Do you see that trend continue on the chart?
See, many of these pharma stocks, I think, had witnessed a very large decline. In fact, the pharma index, if I'm not wrong, yesterday was at a new 52-week low and has been one of the biggest underperformers of the last many, many months. I think stocks have just come off the cliff across the board in pharma. And once again, sadly enough, fundamentals just don't matter. But as you rightly pointed out, Dr. Reddy's has been relatively steadier in the last 1 month. It has shown some relative outperformance. There is a possibility that at the recent 3,700, 3,800 level, it could have made a bottom. But still, I'm not very convinced of going out there and buying pharma even now. It could be a short-term trading idea. It could be a blip, this outperformance that Dr. Reddy has seen. But I'm more comfortable in some of the other sectors in the market.
Okay. Talking about bulk deal action, Mirae Asset Mutual Fund has bought close to 6.5 lakh shares in Nuvoco Vistas. Their shareholding has also increased by about 0.1% overall in the company. It's a relatively recent entrant into the markets, Gautam. Can you foretell anything about this particular counter? Because ever since its listing, it's only gone one way, and that is downward. Any trend that you can identify for us from here on?
No, unfortunately, I don't have a view on this stock. And sadly enough, if you really look at many of the IPOs of the last 1 year, I think 80% of them have been in a downtrend post-listing. I think that's a very clear trend that we've seen. So all this talk around valuations and Excel sheets of the next 5 to 10 years and all the stories that were built around many of these high-profile IPOs, it's just not worked. I think the secondary market itself is so lucrative right now in terms of valuations and risk reward that I wouldn't want to look at anything where we don't have clear visibility of earnings.
Okay. One more stock that could be in focus today, it's RITES, and they've bagged an order of 365 crore rupees from Concor for maintenance of shunting locomotives. This is a 10-year contract. But let's talk about the technicals of RITES. The stock saw a decent uptick February onwards, but it couldn't sustain that momentum. It's once again back to those 240, 230 levels, which it was 4 or 5 months ago. Talk to us about RITES and its technicals.
If you actually go by the fundamentals and the earnings, it's been fabulous, for a company like RITES, because we have been looking at it from time to time. But unfortunately, if you look at the charts, I think this is one stock that did not do well in the good times. And now in these difficult times, it continues to, go back to making new 52-week lows. So, we are completely away from stocks like these, because if you don't see relative strength, if they don't hold out when the market is weak, it just means that it has inherent weakness. So I wouldn't look at it. But I think the PSU basket looks interesting to me. I've been talking about it as a theme for the next 12 to 18 months. So some of the top stocks in the PSU space, I think, is something which investors should look at, because in today's market, you get that comfort of dividend yield, and you also have the capital appreciation angle, so the Coal Indias and the NTPCs of the world, I think are something which we are recommending to subscribers.
Gautam, a lot of questions are coming your way from our viewers who are watching the show live right now. We'll collate that. Just stay on with us. I want to take it across to Neeraj Gaurh. He's the head of research at Equirus Group. Neeraj, good morning and thank you for joining us. Is it a good time to rejig or review one's portfolio amid all the carnage that's transpiring on the street and across different asset classes?
Yeah, it's always a good time to look at your portfolio with a fresh perspective. But investors need to keep in mind that you need to look beyond the next few months' volatility, because that will be there, wherever you invest in. So not to look at the screen, across during the whole day, and look at your businesses. Study your companies and where you think that valuations are more reasonable. So look at private sector banks. They're in a pretty decent position. They continue to gain market share from public sector banks, right? Where you have the predictability of earnings, the asset quality for the top private sector banks of the country is pretty robust. So have a 3 to year time frame for wherever you want to invest. Cement names have corrected a lot. These are backed by assets, which takes time to replace. Look at select industrials, auto ancillaries, and if you have a 3 to 5 year time horizon, you can look at select consumer discretionary names, because there is a section of population who are seeing wage rises and they'll have wallet to spend. Though there'll be a segment which will get impacted by inflation, but there is a segment which is still doing well, right? So if you have a broader time horizon, look at those names, look at companies which are doing well in terms of fundings and have predictability of fundings, and valuations are not obnoxious, because you are seeing that the correction is massive if you are investing in a stock which is at 100 PE. So look at for reasonable valuations and look for a longer time horizon.
One of our viewers has posted this question. His name is Abhishek, and he's asking, is it a good time to rejig the entire large cap portfolio and invest further when further sell-off occurs? Of course, nobody can time the market, or nobody can tell you exactly at what time or what level to enter. But right now, given what's happening, is it a good time to exit large caps if one is holding, or should they stay put and maybe add more?
Yeah, I think one should add more, because a lot of damage is already into the price, especially on the large cap, So you will see a lot of front ending of Fed hikes this year, right? So in the next 6 months, you will see that a lot of these things will get behind us. Inflation will also possibly peak. And hopefully, if the Ukraine war comes to end before the calendar year ends, you will see, the sentiments will improve and there'll be further easing off on inflationary pressures. Right. So I don't think it's a time to exit large caps, because the damage is already there in the price and you can't perfectly time that, right? So you'll not be able to enter them again at those prices. In fact, if you have got cash flows and you have more money to invest, you should need to add gradually to those large cap names. And if you don't have, then just sit tight, just don't look at the screen.
Okay. One more query that has come up is, can we bet on large cap banks and real estate companies? Do you have a preference between the two, or is there a third, but perhaps theme that you would like to flag off?
So I'm more positive on the private sector banks, because that's far more a secular run, that will continue to have that run for next 5 to 10 years. So you can pick, any top 2-3 names from the top 4-5 private sector banks, so that'll be easy for you to do as an investor, that which names to select on. Real estate is far more cyclical. Obviously, now we are entering a good cycle where you're seeing a lot of demand is coming in, but you will have to carefully select players, which one to back, look at their balance sheet, their launches, and you need to study them better. But it would be far easier as a retail investor to look at the top private sector banks and to pick names among them and stay invested in them for, next 5 to 10 years.
Given the way things are panning out, the way macro data has been, ongoing geopolitical tension between Russia, Ukraine, of course, tightening of monetary policies as well. What is the kind of portfolio that one should make? Perhaps if I were to enter the market today, or anybody, any of the retail investors are looking to enter the market today, how should they construct their portfolio? Perhaps in terms of percentage breakup, if you could tell us what would be an ideal sort of a holding to have?
Yeah, first of all, you need to have an investment philosophy, that what are you looking at, and what is your time horizon. So I'm assuming that most of the investor, would here be looking at 3 to 5 year time framework. And you need to pick up companies where you believe in that time horizon that their market position will be what it is, or they'll improve from here, right? If a company is losing market share, and even if the addressable market is huge, you'll not be able to create wealth just because it has a good market share today, right? But it's on a losing path. So look at companies which have a stable to improving market share. Maybe in interim, some may have margin pressures and profitability issues, but you believe that with inflation cooling off, so those could be actually good ideas, that you can pick those companies where transit pressures, but you believe that in a 3 to 5 year horizon, they'll have the pricing power to come back to their normalized margins. So pick those companies, pick solid companies where you can predict that next 3 to 5 years, they'll be there, they'll not go obsolete, and have a portfolio spread across at least 4 to 6 sectors. Financials is one space which I talked about. So you can have a pretty good allocation, let's say, between 25 to 35% kind of allocation to the financials, because they'll do fantastically. Then you can have allocations to industrials, auto ancillaries, cement, consumer discretionary names. IT, I think there's still some space to correct more, but once there's a little bit more correction in IT names, you can look at the large cap IT names. Mid cap names, I believe they are still, highly priced. So you can see a little bit more correction onto the mid cap IT space, and you can build the portfolios around these 4 to 6 sectors.
Okay, all right, Neeraj. Thank you so much for chatting with us this morning and helping our viewers out with their questions and by telling them how they can start building their portfolio if they're not already invested in the market. And of course, it's always a good time to review and fix if there are any issues in the portfolio. Gautam Shah is still with us, and let's continue talking technicals. Gautam, several queries have come up, and Vishal was talking about how he's betting on consumer discretionary, and one such stock is Titan, and we repeatedly get a lot of engagement and a lot of queries on Titan. Narendra Pandey has just written to us this morning. What is your view on this particular script?
To be honest, I wouldn't be very positive on it. I think it's had its run. Some of these stocks, had a fabulous run over the last 1.5 years. They did not even see a 10% correction while the run-up happened. And now at current levels, I think the risk reward is not justified. The charts are not great. And actually, if you really look at it, the stock has not corrected as much as many other names in the market. So I think there is a lot more potential. But if you have to play this space, there are a lot of stocks to, look at. So ITC, I think, remains on top of my list because it gives you the dividend yield. It gives you a solid brand, and it gives you a business which has visibility, and it's pretty much under-owned, given its recent, I would say, underperformance of the last many months. So ITC is something that I will look at, and some of the other FMCG names also, and if you have to play the space again, for example, a name like Jubilant Foodworks, Devyani International, they're all play on the India consumption story, and I think they could do well. So you have to be very careful in the kind of businesses, the charts and the brands that you're looking at these prices.
Okay, all right. The same viewer is also asking us a question on SRF. Can you tell us what the technicals are hinting at? Which way is it headed?
It's still weak. I think chemicals again saw a wonderful run up, and many of these chemical stocks have lost anywhere between 30 to 50% from their highs. SRF, despite the positive earnings last quarter, I think the stock refused to do well. I think this is a trend that we've seen in the last 2 months, that earnings are not impacting stock prices anymore. Whereas the whole of last year, earnings kept coming, they were positive and the stock reacted to that. So there is clearly a change in dynamics in terms of demand and supply. And SRF is something I would not look at from a near-term perspective. If somebody has a very long-term, 3 to 5 year horizon, something that we don't look at Goldilocks, then maybe you can look at some of these chemical names. But otherwise, I don't see it as an option right now.
Okay. Mahesh is asking, do healthcare, pharma, FMCG sectors act as defense plays during recession? Very pertinent question, given that the fears of recession, is something that everybody has been talking about and concerned about. But do these three themes, can they be used as a contra bet on recession?
I'm not very sure about healthcare because I don't look at fundamentals deeply, so I might not be the right person to answer this question. But with my experience of the last 2 decades, I do believe that FMCG is one space which is a good sector to hide during such phases. If at all there is a recession and it's going to stay for some time, that itself is debatable. I think it's being talked about world over. But FMCG, I think, definitely gives me a lot of comfort because you've seen in the last 2.5 months, I think FMCG stocks have just got sideways while everything else in the market have corrected very deeply. So yes, I think FMCG is a good place to hide in the current market environment.
Okay, all right. What about HFCs? You were telling us about how you are optimistic about real estate companies. So Vignesh has posted a question that what is your view on housing finance as we are seeing a huge growth and spurt in real estate rather?
Well, housing finance as a space hasn't done well. I think stocks across the board have been in supreme downtrends, and it just looks bottomless, unfortunately. So I would stay away. I think today is the kind of market where you want to stay in the top names in each sector, stay with the leader or stay with the challenger. So that's probably the reason that I want to look at real estate as a bigger basket. And within real estate, I still want to, go with the top 4 names that I mentioned. Housing finance, yes, is a story that can play out. But as a technician, seeing prices make lower tops and lower bottoms on a weekly basis, it's not right for me to recommend some of these stocks. I would still go with the DLF and Oberoi and a Prestige, where I think the medium-term, long-term charts are very good. And I think once the market rebounds, I'm very confident that some of these names will do exceedingly well.
You were talking about consumption plays, and there's a question on Pidilite from Partha Purkayat. Do you think Pidilite also merits a look at this point in time?
See, again, you go back to the debate of growth versus value. While you might have visibility of earnings and it's a wonderful brand, no doubt about it, but in terms of earnings and in terms of the valuations that stocks like Pidilite trade at, it's a little questionable, to be making serious investments at current levels. And let's not forget, most of the good news, the earnings of Pidilite is now pretty much in the price, with the kind of bull market a stock like Pidilite has seen, not just in the last 2 years, but I would say in the last 5 to 7 years. So I think this is a time to look at more value over growth. And after the large correction, I think there are many other sectors and names in the market to concentrate on. So I'm not so kicked about it, despite it being such a strong brand.
I want to draw your attention to a JSW Energy as well. We have a query from Abhilash. This counter has, in the last 2 months, weakened quite a bit, losing almost 140, 150 rupees for its investors per share. Talk to us about JSW Energy and its future prospects technically.
Well, we like it from a long-term perspective. So I think that view remains intact. But again, let's not forget the stock went up 5 times in value, or almost vertically, in that 2021 period. So it got a little overdone at the top, and that's why this correction has taken place. Now things seem to have died down. The stock is now approaching a very important support in the form of 190 to 210, and the chances of a rebound from here are quite high. And with what I hear, I think it's a stock and it's a company that can do well. So if you have an investment horizon, definitely go ahead and make commitments into JSW Energy.
Okay. Gautam, just before we let you go, one question I would like to ask from our viewers is that can Nifty hold 15,000 levels until the next Fed meeting? So clearly the rate hike cycle is something that investors are now very closely following, and they're very worried about the key market levels to watch for. So 15,000, do you think the Nifty will be able to hold?
It's a tough call. These are psychological levels which obviously impact every market participant. But but as I mentioned earlier, I think for me the number is around 15,000 to 15,150. So that's the immediate number that I am working with. But if this were to break, I wouldn't rule out a move down to as low as 14,400. So if you ask me what my worst case is, it's about 14,400. But any which way, between now and 14,400, if we were to get there, is an opportunity to go out and buy. It doesn't make any difference whether these numbers come or go. The idea is it an opportunity for the next 1, 3, 5 years? The answer is yes.
All right then. Thank you so much, Gautam. Always a pleasure having you on board and getting insights from you on a host of sectors, stocks and themes to watch out for. That's all we have in this edition of Morning Trade. Stay tuned. Markets with Santo and CJ is coming up next.